This pound sterling to US dollar setup reminds me of the June 2018 breakdown, and that's not a good sign. The pound is trapped in a diamond consolidation pattern, but institutional order flow suggests a swift move to 1.3300 if 1.3380 fails. The Fed's still hawkish, the UK's in a data vacuum, and August is historically brutal for the pound. See the exact entries and invalidation levels I'm watching for the breakout trade in the full analysis. Watch this level closely. It may define the next 500 pips of movement. This setup on pound sterling to US dollar is flashing a warning that I have seen before, one that reminds me directly of the June 2018 breakdown. Back then, the pound was sitting in a similar diamond pattern, the Fed was restarting its hiking cycle, and the Bank of England was looking weak. And when it broke, it dropped nearly 800 pips in a matter of weeks. I think we may be staring at a comparable moment right now. The seasonal August curse is upon us, the dollar is regaining its safe haven bid, and institutional positioning is leaning heavily toward the downside. If you are trading this pair in the next 24 hours leading into the NFP, you need to be aware of this structural vulnerability. Let's get right into it. I am maintaining a firmly bearish bias on pound sterling to US dollar for the session ahead. The pair is currently trading around 1.3451, and while we have seen some consolidation, the broader weight of evidence is pointing lower. My invalidation level is a clean 4-hour close above 1.3480. That would be the signal that something has changed in the immediate supply-demand balance. Until that happens, I am looking for sell opportunities on rallies, and I am positioning for a potential breakdown of the 1.3380 support level. I want you to think about this carefully because the risk-reward is asymmetric here. If that floor breaks, the next target is 1.3300, which represents a significant institutional liquidity level. This is the weekly verdict, and it's where I'm anchoring my entire trading plan. Let's start with the monthly chart, because the seasonality is not just a statistic, it is a structural tailwind. Since 1971, August has historically logged the worst monthly performance for the pound, averaging returns around negative 0.5%. This is not random. It is driven by liquidity flows and institutional portfolio rebalancing as summer trading volumes thin out. The monthly trend is firmly bearish. Moving down to the weekly chart, we are consolidating broadly within a defined structural range of 1.32 to 1.36, but the bias is now shifting to neutral bearish. The weekly candle is currently showing a rejection from the upper half of that range, which is a sign that sellers are gaining control. I have seen this exact divergence 3 times in my career. Twice it led to a violent reversal, once it didn't, and here is the tell. The tell is the fact that each bounce is getting shallower and the momentum indicators are making lower highs. This is classic distribution behavior, now on the daily chart. The structure is particularly alarming. We are forming a bearish corrective phase under a multi-month diamond consolidation setup. This diamond pattern is a notorious reversal signal. If you look at the moving averages, the current price is trading below the MA5 at 1.3440 and the MA10 at 1.3452, while the MA20 is sitting at 1.3468. The key is that the MA20, which has been a support level for months, is now sloping down and becoming resistance. The MA50 at 1.3430 is the only level providing some near-term support, but the MA100 at 1.3410 and the MA200 at 1.3375 are looking increasingly like magnets for price. The ADX, which measures trend strength, is at 24.15. This is just above the 20 threshold, indicating that a directional downtrend is becoming active. But it's not yet at 25 or 30, which would signal a strong trend. This tells me that while the bias is bearish, the momentum could accelerate rapidly if we get a catalyst. The CCI is at negative 112.40, which is accelerating below the minus 100 baseline into minus short-term oversold zones. This could provide a brief bounce, but it's a counter-trend move in my view. And the RSI at 44.50 is slipping firmly beneath the 50 midline, which is a crucial psychological threshold. When the RSI is below 50 and declining, it signals that sellers have immediate structural control. The stochastics are also confirming this, with the %K at 28.10 and the %D at 36.40, showing a negative momentum crossover accelerating toward the lower borders. And the MACD, which is the most important indicator for many institutional traders, has a signal line at 0.0004 and a histogram at negative 0.0006. This bearish distribution is expanding below the zero barrier, which suggests that selling pressure is building. The Williams R is at negative 78.10, plunging rapidly toward the lower overbought threshold. On the 4-hour chart, the picture is even more bearish. We are fleshing out a clear downward wave structure toward short-term targets. This is not just choppy consolidation. It is a defined impulse move. And the 1-hour chart is experiencing active selling distribution below the intraday moving averages, which means the sellers are pressing their advantage. I want to cross-reference this with Euro to US dollar, which is showing a similar distribution pattern. When you see both major dollar pairs exhibiting the same structural weakness, it reinforces the idea of a dollar strength story rather than a pound-specific weakness. And I also watch US dollar to Japanese yen, which is holding strong above 148. The correlation is not perfect, but the overall vibe from the G10 space is that the dollar is the king of the hill right now. Now here is where I weave the fundamental story directly into the technical commentary because they are inextricably linked. The pound is not just falling because of a few lines on a chart. It is falling because the fundamental backdrop is providing the fuel for this technical breakdown. The primary driver is dollar strength returns. As safe haven demand is creeping back into the US dollar index because of persistent geopolitical risk and high energy prices. These external factors are solidifying Federal Reserve policy expectations. The market is now pricing in a 60% probability of a September rate hike, and that is a huge tailwind for the greenback. The yield differential is widening, and that draws global capital back into dollar-denominated assets. On the flip side, we have a UK catalyst void. The Bank of England kept its benchmark interest rate at 3.75% during its July meeting, and there is no major domestic data to provide a protective catalyst for sterling. This leaves the pound entirely exposed to international sentiment, and right now, that sentiment is being driven by the dollar. I am watching the calendar closely, because this is where the near-term volatility will come from. Tomorrow, we have the US ISM Services PMI, and I will be focusing specifically on the prices paid component. That is the inflation proxy for the services sector, and if it comes in hot, it will cement the Fed hike odds and send the dollar spiking higher. We also have the ADP National Employment Report, which sets the baseline for Friday's NFP. If ADP beats expectations, the market will start pricing in a massive NFP number. But there is also a potential twist. If ADP misses to the downside, we could see a temporary relief rally in the pound, but I would view that as a sell the rally opportunity. On day 2, we have UK construction PMI data revisions, which is a minor intraday driver for localized sterling volume. It is unlikely to move the needle significantly. And then on day 3, we have the big one, the US non-farm payrolls employment report and the national unemployment rate. This is the high-stakes event. The consensus is looking for a number, but any deviation will trigger a massive programmatic response in the FX market. This is why I am positioning my trades with tight stops. I do not want to be caught on the wrong side of that volatility spike. I have seen this dynamic before, back in June 2018, where the market was waiting for a catalyst, and when it came, the breakout was explosive. It was the same setup, a consolidation pattern, a hawkish Fed, and a vulnerable pound. And the move that followed was swift and unforgiving. If we break 1.3380 ahead of the NFP, I think we could see a preemptive liquidity slide toward 1.3300, and then the NFP will decide if we bounce or continue lower. Based on this analysis, I have identified 3 high probability setups that align with the bearish bias while still accounting for the potential for a short-term bounce from oversold conditions. Let me start with the first scalp trade. This is a long scalp execution designed for the M1 to M5 chart. The trigger is to wait for a sharp, fast liquidity rundown into the 1.3400 to 1.3418 support block. This is not a trade I take passively. I want to see a violent spike down that shakes out the week. Longs. Confirmation comes when I see an M1 or M5 bullish structure shift, like an inverse head and shoulders pattern, or a strong engulfing candle. I also want to see the RSI recover out of deep oversold territory, specifically below 30. That tells me that the sellers are exhausted and the buyers are stepping in. My stop loss is at 1.3385, which is safely below the local structural support markers. I am targeting 1.3435, which is the daily pivot point alignment, and if the momentum is strong, I will scale out half the position and trail the stop for a run to 1.3450. The risk-reward on this trade is roughly 1 to 1, but the safety of the stop makes it a high probability scalp. Now for the second scalp. This is a short scalp execution. The trigger for this is a swift, corrective run-up to test the short-term intraday ceiling between 1.3465 and 1.3480. I want to see clear candle rejection wicks on the short timeframes, which indicate that the selling pressure is coming back in. Confirmation is a bearish stochastics crossover in the overbought zone, specifically above 80. This is the classic overbought reversal signal. My stop loss is at 1.3495, positioned safely above the local swing high structure. My take profit levels are 1.3435 and 1.3415. This trade is based on the idea that any upside is a corrective move within a larger downtrend, and I am looking to short the failure. Now here is the third setup, the swing trade. This is the breakout breakdown bear scenario. This is the one I am most excited about because it has the potential to capture a sustained directional move. The trigger is a definitive H4 candlestick close cleanly below the 1.3380 support floor. This will trigger a broader daily consolidation breakdown. The execution is to enter short on a corrective pullback to test 1.3380 from underneath as new resistance. This pullback is a gift, a chance to get into the trend at a better price. The stop loss is at 1.3440, safely above the H450 period moving average line. The take profit is 1.3300, which is targeting a deeper, long-term institutional liquidity sweep. This is a 1 to 2 risk-reward trade, and it is the one I am scaling into. Do I want to make a quick point here? These setups are not predictions, they are plans. I am going to let the market tell me which one to take. If we break 1.3380, I am not going to be a hero and try to buy the low. I am going to sell the failure. And if we bounce off the support, I will look for a long scalp. The key is discipline. Risk management is the unsung hero of consistent profitability. I don't care if you have a 90% win rate. If you don't manage your risk, you will blow up your account. For these setups, I am advising a maximum risk of 1 to 2% of your account per trade. For the scalps, because they are high-frequency trades, I recommend a lower risk, say 1%. For the swing trade, where the risk-reward is more favorable, you can push that to 2%. Here is a personal rule I live by. I never place a stop loss based on a random number. It always goes behind a structural level. In this case, my stop for the breakdown trade is above the H450 MA and the pivot point, which gives me a buffer against a false breakout. I have seen so many traders get stopped out by a random spike because they placed their stop too tight. I also scale out of positions. Notice that in the scalps, I am taking partial profits at the first target and moving the stop to break even. This protects my capital and allows me to let the winning trades run. This is not just about making money. It is about staying in the game. The market will always be there tomorrow, but your capital might not be if you are reckless. If the NFP numbers come out and we get a massive spike, I am going to be extra cautious, maybe even step aside if the move is too violent, because chasing the market is a losing game. I'd rather wait for the dust to settle and re-enter on a pullback. Alright, let's wrap this up. The key level you need to watch for pound sterling to US dollar today is 1.3380. As long as the pair holds above this level, we are in the consolidation zone, and you can trade the scalps. But a decisive break below 1.3380 is the trigger for the bearish swing trade, targeting 1.3300. Keep a close eye on the US ADP report and the ISM Services PMI, because these will set the tone for the rest of the week. Remember, we have a comprehensive Sunday weekly outlook that goes live every week covering all the major events and key levels for the coming days. And on Friday, I will be doing a live analysis of the NFP numbers, so make sure you are subscribed with the bell on so you don't miss that. If you found this analysis useful, please hit the like button and drop a comment below. Let me know where you think pound sterling to US dollar is heading next. Do you think 1.3380 holds, or are we heading to 1.3300? I read every comment and I'll pin the best one. I am Eric from the Meridian Decoded channel, and I'll see you in the next video. Stay disciplined and trade safe.